Jerome Powell's keeping rates high, but your wallet is feeling low. Why is the Fed stalling, and what does it mean for you? Let's dive in. Welcome back. My name is Stephen Spicer, and it's my goal to help you invest smarter. In this video, we're diving into the Federal Reserve's interest rate strategy. In May 2025, Fed Chair Jerome Powell announced that rates are staying put. But there's a lot more to this story. From tariffs to inflation risks, we'll explore why the Fed is hitting pause, how this approach has evolved, and what it means for your finances. All right, so on May 7th, 2025, the Federal Reserve decided to keep the federal funds rate at 4.25% to 4.5%. That's unchanged since December 2024. Jerome Powell emphasized a cautious wait-and-see approach, driven by uncertainties from President Trump's trade policies, including a 30% tariff on Chinese goods and 10% import from Canada and Mexico, and so on. The economy is growing at a solid pace, with the unemployment rate steady at 3.8% in April 2025. But inflation at 3.1% year over year in April 2025, according to the Bureau of Labor Statistics, remains above the Fed's 2% target inflation. Between us, since it's been hanging out there above 3% for so long, it sounds like it's time for the Fed to run some numbers and determine that the inflation target should actually now be 3%. Yeah, that feels right. We can make the maths work out for that, right? I mean, we're just kind of flying by the seat of our pants sometimes, making this up as we go, right? Yeah. Sorry. I don't know what came over me. Anyway, Powell noted the risks of higher unemployment and inflation are rising, particularly due to trade disruptions. And now, with the historic Moody's downgrade of the US credit rating making headlines, Powell's team is treading carefully. More on that US downgrade in a bit. Their strategy reflects the Fed's dual mandate, achieving maximum employment and price stability. He's not rushing to cut rates, saying the economy is resilient and doing fairly well, as quoted by NBC News. The Fed is also reviewing its monetary policy framework, acknowledging that the era of ultra-low rates may be over, with supply shocks potentially driving more inflation volatility. Tariffs are a big reason for the Fed's caution, or at least they're the current excuse. Trump's policy, including a 30% tariff on Chinese imports and 10% on goods from Canada and Mexico and so on, are pushing up prices. For example, Walmart announced that it'll be raising prices on items from bananas to electronics due to these tariffs, with more hikes expected in June of 2025. The National Retail Federation estimates tariffs could cost families $2,000 to $3,000 annually. These price increases fuel inflation, complicating the Fed's efforts to hit its 2% target. Powell warned that these supply shocks could lead to greater inflation volatility, making it harder to predict economic trends. Powell is walking a tightrope, trying to balance this peskily persistent inflation and our potential economic slowdown. The US economy contracted in Q1 2025, with GDP shrinking for the first time in 3 years. At the same time, the labor market remains resilient. The unemployment rate held steady at 3.8% in April 2025, near historic lows. Powell warned that tariffs could slow growth and hurt jobs, making his balancing act even more tricky. To understand Powell's approach, let's look at how the Fed's strategy has evolved. Believe it or not, the Fed didn't used to have a target inflation. No inflation was A-okay. That sounds like how it should be, but what do I know? In the early 2000s, the Fed started to give hints that it was targeting an inflation rate of about 1.5%. It wasn't ever that specific, but it was alluding to that. But after the 2008 Great Recession, it shifted to a 2% target. That was formalized in 2012, according to the San Francisco Fed. This move supposedly aimed to anchor inflation expectations and stabilize prices, and allow us to be okay with the fact that everything just kept getting more and more expensive. Okay, fine. In 2020, the Fed, allowing themselves a little bit more allowance on the higher side of inflation, adopted flexible average inflation targeting, allowing inflation to exceed 2% temporarily, so that we hit the average to offset periods of low inflation. Now, Powell suggests the lower for longer rate era may be ending, with higher long-term rates likely due to changing economic dynamics and frequent supply shocks. In other words, I personally, as I alluded to earlier, would not be surprised to see them at some point in the not too distant future excuse some sort of upward adjustment, once again, on that target to make their job a little easier, to loosen the tightening noose around the government's neck, and to justify our everyday necessities getting more and more expensive at a faster and faster rate. And ultimately, to kick the can of a worse than ever before crash further down the road. They never do ratchet it the other way. Anyway, President Trump has pushed for rate cuts to boost growth, but Powell has resisted, emphasizing the Fed's independence, which, as we explore in these videos, is incredibly important. In a May 2025 press conference, Powell said decisions are driven by data, not politics. This tension highlights the Fed's challenge, balancing economic goals with external pressures. Tariffs and fiscal policies, like extending the 2017 Tax Cuts and Jobs Act, could add $3.3 trillion to the deficit by 2027, per the Committee for a Responsible Federal Budget, further complicating the Fed's task. This tension isn't new. Trump has long criticized Powell, even floating ideas of direct control over monetary policy, which Powell has firmly resisted. Higher rates help curb inflation, but raise borrowing costs for consumers and businesses. Cutting rates too soon could overheat the economy, especially with tariffs already driving up prices. Powell's team is supposedly waiting for clearer data on how these policies play out before adjusting rates. The Fed's decision here has ripple effects. Those higher borrowing costs I mentioned have resulted in the average 30-year mortgage rate being 7.2%, up from 6.8% a year ago. Businesses face higher financing costs, potentially slowing investment. Despite the Fed's holding pattern, markets expect 2 to 3 rate cuts by year end. However, the Fed's cautious stance suggests cuts depend on inflation cooling, which, given the increased recession concerns and economic uncertainty, seems far from certain. In the meantime, here are your actionable steps to navigate this environment. 1, review your budget. If you're feeling that tightening with tariffs driving up prices, reassess spending to prioritize the things that are truly the most important to you. This pain may not just be temporary. You may need to make an adjustment permanently. Don't take things out on credit or something like that, thinking that it's going to get better in the future. We don't know that. 2, consider locking in fixed rate loans. Secure fixed rate mortgages or loans now to avoid future rate hikes, especially with yields rising. And 3, diversify your investments. If you're doing this all on your own, balance your portfolio with some defensive stocks, healthcare, for example, or you could look into some dividend aristocrats or bonds. All of that can help to mitigate volatility. It's not my favorite way to protect your portfolio, but if you're only here for a quick soundbite, in that case, it's probably the best advice given that circumstance. But if you're actually taking this seriously and really want to protect yourself, no matter what flavor of chaos ultimately comes over the horizon, that's what our Financial Doomsday Survival Guide email series walks you through. Because, yeah, there's chaos on the horizon. Just nobody knows exactly what shape it'll take or exactly when it'll hit. Anyway, Jerome Powell's decision to hold interest rates steady reflects a cautious Fed navigating a minefield of tariffs, inflation, and political pressure. Powell's strategy builds on decades of evolving monetary policy, from implicit inflation targets to a flexible framework. But the end of low rates might signal yet another era, one where we're just okay with higher inflation. Again, for consumers and investors, this means preparing for higher costs and market volatility because the risks of higher prices and slower growth are real, hitting both your wallet and your portfolio. What do you think? Will the Fed's patience pay off, or are we in for a bumpy ride? Drop your thoughts in the comments. I'll be there. If this video helped you understand the Fed's moves a little better, I hope you'll hit that like button. As for that earlier promised deeper dive into the Moody's downgrade of the US government, this video's got you covered. I'll see you there.